All right. Well, good evening, everyone. Happy Monday. I'm Davon Reeves, CEO and founder of Vestor, here with Mr. Tommy Beyer. And he's going to be walking you through how to analyze a deal, really like from a high level standpoint, what to look for when you're analyzing a deal. And we would love for it to be on Vestor. If it's a deal that you're analyzing on Vestor or off the Vestor. And if you're looking to passively invest, as well as it's a little bit more if you're looking to buy, it takes a little bit more detail, a little bit more time. But from an investing passively standpoint, um, so I'm gonna pass it over to Tommy. For those who don't know what Vestor is, we are a crowdfunding platform, dual place crowdfunding platform where you can invest in both commercial, you can invest in commercial real estate as well as including hotels and multifamily and other things. Um, and so we host monthly webinars to educate. And so we're happy to have Mr. Beyer. He started off as a car valet for a hotel, and he worked his way up to becoming a general manager before the age of 30. So that's definitely a big thing for folks to do. And from there, he moved into corporate, worked for a management company, and helped launch the REIT. He's an asset manager. He asset managed my properties. It led us to two successful exits, which generated well, he go into details from a case study perspective. But so he knows way more about hotels than I do. So he's a hotel expert. So for folks who want to get a better understanding of how to analyze a deal from a hotel standpoint, or just what to look for, because hotels, the fundamentals are pretty much the same from a real estate perspective. But just seeing, if you invest, and of course you do your own due diligence, right? You do your own due diligence. Both of us were not financial advisors. So, whatever deal that you find, please consult with your tax preparer or your financial advisor, when making investments. So, I'm going to pass over the baton to Tommy.
Good evening, everybody. Good to be with you. Hope you had a nice weekend and your week is off to a good start. Devon, always happy to be with you. I've seen some familiar names, so nice to see some of the familiar people here. And to anybody that's new, it's good to meet you virtually. As Devon said, yeah, been in the hospitality industry. I don't know, 20, a little over 22 years, 23 years, something like that. And known Devon. We've been friends for, I don't know, 15, 16 of those, something like that. And yeah, I have a unique angle because in my experience, I've not only worked at hotels, whether that was, as Devon said, valet or front desk or general manager or VP of operations, where I oversaw portfolios of 15 hotels. But I've also, I also am part owner of hotels, right? So I can help you analyze deals. I can help you, determine if it's good financing, a good brand, a good management company, or the opposite, bad management company, bad brand, bad financing, all bad location, all the above. So. It's not too common that you come across people like that because usually in our industry, if you have been in operations, you sort of stay in operations, or you either get into ownership by sort of starting on like the financing real estate path. So luckily, I can help you analyze a deal, tell you if it's a good deal, and then once the property, if you were to acquire the property, I can tell you if they're doing a good job of running it or not. Some of my clients will bring me on, in my mind, a little too late. So they'll bring me on once the property's a bit of a mess, and then I have to go in and try and clean things up. And then some clients engage with me before they find a hotel, which I prefer because I can help sort of pick and choose and guide them into the right property. So, but anyhow, so tonight we're going to talk through analyzing deals. I want this to be super engaging. So you guys feel free to type in the chat your questions. I'm pretty good at keeping up with those. As an aside, uh, one thing you probably don't know about me, maybe Davon does, but I'm a big women's basketball fan, particularly college basketball. But the reason that's important is right now the WNBA draft is going on. So I got three of my South Carolina Gamecocks should be drafted tonight. So I'm gonna at the end of this, I'm gonna turn the draft on and see where my team went. So I'm a big Dawn Staley fan too. So any other college basketball
I
fans?
now that I did know. I knew you was a Gamecock fan, and I knew that you was a big Non Staley fan. See, I be paying attention to you.
Yeah, so it's an exciting night. So anyways, where are you guys from? Just type in the chat where you're from. We know Hardeep is driving in California, just came out of Arizona, so that's kind of cool. He's a long haul truck driver. I am coming to you from Williamsburg, Virginia. I've also lived in every state from Florida to Virginia. So I'm an East Coast guy. Let's see what we got here. We got Dallas, Texas, Chicago, New York, Dallas, a bunch of Atlanta, Duluth, North Carolina, Florida, Maryland, upstate New York. Okay, Illinois. We're a little all over. Alabama. That's cool. Um, so I would like to, if it's okay with you guys, I'd like to actually go into an actual deal that's on the market. I think it's still on the market. It was on the market as of a few weeks ago, but it's a deal I looked at recently, and I think it's interesting from a few angles. So I want to walk you guys through, um, what I like about it, what I don't like about it, and then I want to get your take on it. Also feel free to let me know, if you guys have been an LP or you've been a GP or where you're at in your journey or you're looking to acquire your first deal or, um, you're just bored on a Monday night and you have nothing else to do besides listen to me talk, which is fine too. So I'm going to share my screen and we're going to jump into this. So this deal is in Stevens Point, Wisconsin. So I didn't see anybody say they were from Wisconsin or Stevens Point, but so the first thing I do is if I get an email from a broker or anybody that tells me, hey, look, there's a hotel for sale, I want to go find out where it's at. So this is a Ramada by Wyndham in Stevens Point. Here's the address, 510 Main Street. So first thing I do is I jump on Google Maps and I want to see what's around this thing, right? And that's important for a number of reasons. One, we're buying a hotel, right? So with hotels, you can kind of draw about a 5 mile radius around the hotel, and that 5 miles is going to be where most of your competition is going to be, and where most of your demand is going to come from. Because once you get outside of that, for the most part, you're going to find another pocket of demand generators and another pocket of hotels. So this one, I didn't know where Stevens Point is. I'm not from Wisconsin, but to give you guys an understanding of where it's at. You got Minneapolis here. It's a couple hours to the west, and then you have Green Bay, maybe another hour to the east. So it's kind of maybe in the middle of the state, if that's fair. You're like, why do I care about Stevens Point? And to be honest, I don't care necessarily about what city or state it's in. I need to understand, what's the local demand generators and why could this be successful or not. So now I understand where it's at. Um, and now I kind of zoom in a little bit closer and, I'm seeing a couple things. One, it's off this Interstate 39. Okay. So I know I can get some interstate business. I do see a lot of land around it, which it's not necessarily a good thing. The reason that's not good is people could go develop another hotel next door to you if they wanted to, right? So I don't love that aspect. And now I'm going to look for kind of bigger rooftops, understanding like, okay, so where are the big businesses, or am I near a military base, or am I near, a university or an airport or whatever? And I'm not seeing any of that, but I am seeing some businesses down in here. And one thing after speaking to the broker, I'll tell you, and it's a little further down here, but when you get down here, you'll see this Del Monte Foods. Okay, Del Monte, you probably may have something, a can in your pantry that says Del Monte, right? They're like they package foods, right? And the reason that's important is this hotel has a contract with Del Monte Foods to provide something like $500,000 or $600,000 worth of business to them every year. And the broker told me that. I was like, well, that's kind of interesting. First of all, the broker had never even been there. He lives in California. He's never even been to the hotel. Good, bad, I don't know. Raises a red flag to me. He couldn't even tell me what the name of that company is. I had to tell him. He's like, oh, it's some food packaging. He couldn't figure it out. So anyhow, you have a La Quinta here. I'm trying to see who are my competitors. A Fairfield Inn here, a Holiday Inn Express, another Holiday Inn. And then further down, there was a Home 2 by Hilton. Okay, Home 2 Suites, which Devon and I own part of a Home 2 in Oklahoma. But so I thought it's sort of interesting, right? That Del Monte Foods is not close, and there's a couple other hotels here, but there's a Comfort Inn and then this Americ Inn. So that's a little far out, and most of the revenue that this hotel generates is coming from that Del Monte Foods. And the reason I think again that's important is if you have that contract with them, they have whoever's staying there has to drive by a number of hotels before they get to your hotel here, if you were to own this hotel. So that's a red flag. Let's just file that away in our memory, right? Okay. The other thing the broker told me is that they have a lease with a restaurateur, a local restaurateur, um, and you can see it here. So it's this I can't remember. It's like called Legacy Family Restaurant. It's apparently it's a really popular local restaurant, and they get I don't know seven or 8,000 a month or something in rental income from those folks. So that's another thing to sort of file away in your memory as we're kind of flipping through. So I'm going to go back to the offering memorandum, and if you're new to hotels or commercial real estate, the OM you'll hear it called an offering memorandum is just a deck that tells you all about the property. It's the same for multifamily or mostly any asset class, right? So in this case, it's going to tell you address, the important information, acreage, 100, so it's 5.87 acres, 114 rooms. It was built in 1984, renovated in 2021. Okay. And then they'll tell you some other information. NOI, anybody know what NOI stands for? No, I'm asking you easy questions tonight. NOI. Somebody tell me what NOI is.
Net operating
There
income.
you go. Boom. Net operating income. Okay. Is net operating income the same as cash flow? Anybody know?
Not sure.
What's the difference between NOI and cash flow? Margaret says no. Margaret, what's the difference? What do I have to subtract from my NOI to get to my cash flow?
Interest, depreciation.
Yeah, well, you got some of it. So interest, so be your debt service, right? So your
Yeah,
interest and
that,
principal. Depreciation, you won't subtract. That's not a cash. It doesn't impact
yeah,
cash flow.
depreciation is not a
Yeah,
cash, yeah.
yeah. But you got it. So take your NOI, and it's important because some people think NOI is the money that you're going to bring home. It's not. You have to take away your principal and interest, right? Yeah, capital reserves, true, and debt service. That's right. Good job, Richard. Interest and principal. Interest and principal. You'll hear people call it P&I. So it's same as your debt service. Okay. All right. So here we go. This hotel, Ramada Stevens Point, $4 million they want for it. You can see it right here. Let me zoom in a little bit for you here. Properties offered at 4 million or 35,000 per key. So you'll hear that in hotels. They'll value things on a per key basis or per room. So you just take the price that they're asking, divide that by the number of rooms, and that's how you get to the per key number. And per key is important because sometimes people value hotels based on replacement cost, right? So it means if I had to go build this exact same hotel on this piece of land, how much would it cost to do today, right? Uh, anybody have an idea what a typical, let's say a Hampton Inn, let's say we had to build a Hampton Inn next door to this right here. We're gonna build a Hampton Inn right here, right next door to this Ramada. What's that gonna cost on a per key basis? Somebody give me like a range. Give me a $20,000 range. So somewhere, 100 to 120,000, 200 to 220,000. Where do you guys think that falls today in today's dollars? I'm really testing you guys. Had a long day at work, coming off of spring break, maybe. So I'll tell you that. Okay, so market says 40,000 per key. Give me some more guesses. So if I was, let's say I'm building a 100-room Hampton Inn, 20,000 per key. Okay, you guys are some really good builders. A typical Hampton Inn, there we go. All right, 98,000. Monica's going high. So a typical Hampton Inn would cost you about, let's say on the low end, about 150,000 per key, and more on the high end, about 170, 180,000 per room. And so that's a lot of money, right? So this is saying this is below replacement cost. So the price per key can vary depending on the brand, the location, right? So if I'm going to build a Ritz-Carlton in South Beach, it's going to be a whole lot more expensive than I'm building a Hampton Inn in Stevens Point, Wisconsin. Okay. All right, so back to this deal. So it's 35,000 per key. They're saying it's flagged as a Ramada. So flagged, you'll hear that in the industry. Flag means literally what flag are you flying on your property, or what franchise are you? So it's flagged as a Ramada, and with more than $500,000 in available key money. Anybody know what key money means? You guys need me to explain it? Of course you do. That's why you're here, right? Key money comes from the brand. So what they'll do is they call it key money because it's priced on a per key basis. Just like we went over how your hotel can be priced as per key, the brand will give you money per key. And they'll say, all right, Margaret, we want you to keep this Ramada, and because we want you to keep it a Ramada, we're going to give you $5,000 per key. So you have a 100-room hotel, you get $500,000, right? Or you want to take it from a Ramada to a Choice property. Do you want to take it from a Ramada to a Quality Inn? Well, Choice might come and say, well, we want to give you $6,000 per key to make it a Choice property, right? That's called key money. There's all kinds of other things associated with that, like you have to do a PIP, which is a property improvement plan. And sometimes that key money is given in the form of like a short amortizing loan. So it's just sort of burns off over a period of time. So anyhow, they're saying, so if you buy it for 4 million, you might be able to get 500,000 in key money from Ramada or Wyndham. So now all of a sudden you didn't pay 4 million, you paid 3.5 million. Okay. Then it says the hotel demonstrates strong in-place performance, generating over 1.2 million in revenue, and an additional 100,000 in gaming income and 50,000 in annual triple net lease income. Okay, so don't worry, I'm not going to read all this verbatim. I'm not going to kill you with PowerPoints. But sometimes it's important, oftentimes it's important to read through these. You don't have to read everything, but sometimes these brokers put some good information in here. But this is just setting the table for you, okay? So you're going to get 1.2 million in room revenue, 100,000 in gaming income, and 50,000 in triple net lease income, okay? And the seller will consider purchase price adjustments based on key money assumptions in the scope of completed renovation, with greater consideration given to offers demonstrating certainty of execution and an expedited closing timeline. Buyers may elect to acquire the property with or without key money, subject to corresponding price adjustments. So this is really, honestly, this is really good information in the first paragraph here. You don't really see this much intel given from a lot of OMs. So it's pretty it's pretty good insight, right? And then here they talk a little bit more about the market and what we already talked about. Property provides a strong advantage in securing annual business contracts for up to 70 plus rooms. Has a contract from Del Monte Foods for 5 months each year, right? So anyways, it's interesting, right? I find the deal interesting because first of all, you have a couple of different sources of income, which is not super common for a hotel like this. You have gaming income. So what are we talking about gaming? Are we talking about video games? What are we talking about? We're talking about slot machines. So in the lobby, this place has a couple of slot machines. I think we have a picture of it here, and I'll find it somewhere. They have a couple of slot machines that generate income for the owners. Let's see if we can find it. Not that you haven't seen a slot machine. Yeah, here they are. Okay. See, they have maybe, well, that's an ATM. That's, I think, 3 total slot machines or video poker or whatever they are. So that's interesting because that's pure profit, right? That money goes right to your bottom line. And then they also have that lease with the restaurant next door, which is also, this is the restaurant next door, which is also pure profit. It goes right to your bottom line as well, right? So anybody interested in this deal? We like the deal, we don't like the deal. What are we thinking so far? Somebody tell me what you think.
I like it.
Yeah, okay, a couple people are interested. Here's your, that's okay. So Cynthia doesn't like the restaurant. So here's some other things like, look, this does not look like an indoor pool area to me. I don't know about you guys, but I don't want to go swimming in this place right here. Do you want to swim? Anybody want to swim here? You can't even see the pool, right? So there's work to do, right? So the story on it goes something about it's a family that owns it. The son is running it, and the father doesn't believe the son's going to be able to finish the renovation. So they think they took it from one brand to the Ramada or an independent to the Ramada, and that's how they got the key money. But they have yet to finish that renovation, which is why you see this pool area look like this, and you see this other area kind of look, doesn't look the best. So there are things that you have to do if you were to come in and buy it to finish the renovation or the PIP, which is that property improvement plan. And then Ramada would give you the key money, right? So that's, I wouldn't say it's questionable, but it's work you have to do, right? So you hear people say no such thing as a free lunch. Well, that's true, right? So here's your pictures. I know the lobby or the guest rooms don't look the best to me, but I think they're okay. You have to keep in mind it's a Ramada Inn, right? We're not talking about a super high-end property. It's an economy property, right? So a couple people are asking what's the hold period or what's the minimum investment. So the minimum investment, I talked to the broker. I think you can probably pick it up for not 4 million, but probably 3.2 million, somewhere around there. And if you got the key money, now all of a sudden you're down to maybe 2.7 million and it's 114 rooms. So all of a sudden your price per key is pretty low. And Cynthia is likely right to some extent. So, you hear them talk about this in that if you'll pay attention, let's jump back to this paragraph here because I think it's really important. Let's call it out real quick. This broker is saying the seller will consider purchase price adjustment based on key money assumptions and the scope of completed renovations. And it says with greater consideration given to offers demonstrated certainty of execution and an expedited closing timeline. So they said a lot in that run-on sentence, but essentially what they're telling you is they'll sell it to you for less if they believe that you have the money to get the deal done and can close quickly. And that kind of ties into what Cynthia just said in the chat. So she's saying, when you do a deal with a new brand, they say you have a certain time to get this PIP or this renovation done, right? And that could be 12 months, 18 months, 24 months. It could be however you sort of negotiate that. And that timeline holds true for whoever purchased it and whoever negotiated and signed that deal. Usually, more often than not, the brand is willing to work, especially a Wyndham, they're willing to work with a new buyer. So, all right, so you go to Wyndham and say, hey, look, I'm buying this and I need a little bit of time, but we're going to get this done. Usually they'll work with you on that, unless they've been hung out to dry for 4 or 5 years on this and they're just sort of tired of the deal. But you would figure that out in your due diligence process, right? And then you could almost write up the contract saying something to the extent of, we'll give you, let's say you're going to give you 3.5 million contingent on having, enough time to get the key money or get the renovations done and secure the key money, something like that. Um, you know, and here they're saying here, buyers may elect to acquire the property with or without key money, subject to corresponding price adjustments. So, this deal has a little bit of hair on it, right? And what I mean by hair is it's not a clean, straightforward deal. You've got key money, you have a renovation that hasn't been done, so you have some key money hanging out there. You have a contract for 70 rooms for 5 months with a company that's 5-6 miles away that they have to drive past other hotels. You have a lease with a restaurant, and you have this money, supposed $100,000 a year coming from the slot machines, right? So there's a lot going on, right? But sometimes that's where you find opportunity, right? Sometimes these are deals where it's like, okay, well, maybe there's something to be done here. I could tell you that this is a deal where an institutional investor would never touch, right? By institutional, I mean firms that are larger, maybe they're publicly traded, maybe they have, a big portfolio, that sort of stuff. They wouldn't want to be bothered with this. It's too small of a deal. There's too many sort of headaches, potential headaches for them. They wouldn't want to be, worried about, what happens if the restaurant tour goes under, files for bankruptcy. What happens if people stop gambling? What happens if you don't get the PIP done, right? So there's a lot of sort of hanging knives, if you will. But there is opportunity, right? So let's see. Let's jump in. Any more questions on this deal? I want to jump into my analyzer. I'll show you guys how I analyzed it. I want to leave time as well for Q&A, not only on this specific deal, but on anything else you may have. And to be fair, I think it's helpful to actually put up a real deal and not just talking hypotheticals, right? So that deal is actually out there. It's a deal you can go chase down if you wanted to. If you wanted to buy it, you could. If you need help with it, I could help you with it. All right, so here's my deal screener slash analyzer. The point of this one is this is just to do a high level analysis on properties. It's not to do a full blown pro forma. If you don't have the analyzer, either you can get it from my website or Devon can get it to you, or I've got it all over the place. I think I even have it on Etsy, I have it on eBay, I've got it all over the place. So it comes with some of my books. You can go to my website and buy some of my books if you're interested. I'll put my links in the chat at the end. But anyways, there are instructions. There's sort of an instruction tab that shows you what to do. But here is how we do this. And if you've heard it before, it's good. It's a good refresher. If you know how to use it, you can listen in, whatever you like. But you're going to fill in anything that's in blue. So your property name, keys, the year it was built. It's pretty easy. You're going to plug in your acquisition price. The next thing you're going to plug in is your working capital. So I've got 150,000 baked in here. You might say, like, what's working capital for? And that's like any business, right? If you're going to start a business, you need working capital to get it going. You have to fund payrolls. You might have to put down utility deposits. Maybe you have to pay like a license transfer fee with the franchisor. There's all kinds of things you need. Maybe you have a little bit of legal, whatever, right? So that's working capital. You'll notice I left key money blank for the time being. I just kind of wanted to evaluate the deal without it, just to see what it would look like. And I did drop my acquisition price to 3 million. So you could argue that either way. You could say maybe it's 3.5 million and we put in the 500,000 in key money. Again, the beauty of this analyzer is you can kind of tinker around with it and until you feel comfortable with your numbers. Your PIP, which we talked about, your property improvement plan, I have 570,000, so that's 5,000 per key. You'll see it's calculating all your per key over here. And then some closing costs, right? Whether you have to pay for origination fees with the lender or again legal costs or whatever the case is. So total we have here 3.8 million. That's 33,000 per key. So it's a pretty good price per key. So that's your deal data. Any questions on that? Thoughts, concerns? You got it. It's pretty straightforward. If you do put in key money, make sure to put in negative. So if you want to put in, we could put in the key money here, 500,000 if we want. But I think if you're gonna assume it with the key money, it's probably gonna have to go up to 3.2 or 3.3. And it's negative because it's reducing the price of the deal, right? It's reducing the cost. The other thing to note about this PIP is you won't really know what that PIP is. You'll have an idea, maybe you have the PIP in hand, but there may be money that you have to spend beyond that, right? Because some things, as an example, that a brand doesn't tell you in a PIP is they might not tell you that the plumbing, this thing was built in 1984, maybe the plumbing is bad and you have to replace a lot of the pipes. Or maybe the boiler is old and you need to replace the boiler. Or the HVAC units are old, you need to replace those, right? The brand doesn't care as much about that. They care more about is the mattress new? Do you have the newest TVs? Do you have the newest door locks? Do you have the latest, linen or whatever? So that's what you're gonna see on a PIP. All right, so if you want to go tour it as an example, you might go in and say, all right, I know the PIP says the brand says we need to put 500,000 in, but I know we need a new elevator and that's going to cost me 100 grand or whatever to modernize the elevator, something like that. So then we're going to jump in and put our historical data in here. Okay, so this only has room for 3 years. You don't really need a whole lot more than that necessarily, not for an analyzer. And you'll see this is actually the historical data for this deal. And it's messy, right? It's messy because look, there's no occupancy. So that's a red flag, right? It doesn't mean they didn't sell rooms. It just means they don't have good data to give you. And that is pretty common with these economy deals. So you have to just look at that and you have to sort of work your way around that. And I'll explain that in a minute. But hopefully, when you get the historical data, you can plug in the occupancy, you can plug in the ADR, then your RevPAR and your room revenue will calculate. Is everybody comfortable with how to calculate occupancy, ADR, and RevPAR? Anybody need a quick refresher on that? So, okay. All right. I'll give you a quick refresher and I'll jump in. I know you have a couple of questions, Cynthia. I see them. So look, occupancy is real easy. It's just the rooms you sold divided by the rooms available. Okay. So if I have a 100-room hotel and I sold 50 rooms that day, what was my occupancy? Hard math today, guys. 100-room hotel, I sold 50 rooms. What was my occupancy as a percentage? There we go. Steve's got it. Boom. 50%. Okay, so that's easy. Occupancy is easy. Same for multifamily, right? Okay, now ADR stands for average daily rate. The calculation there is the room revenue that you had for the period divided by the rooms sold. That's your average daily rate. So it's just literally what's the average rate I sold the rooms for that I had, right? That I sold. So let's do easy math because it's a Monday at 7 and we're all tired from the weekend. Let's say we brought in $1,000 in room revenue and we sold 10 rooms. What was our ADR? There we go. Easy. 100. Perfect. So our average rate was 100. So, a little quick aside on the history of this stuff. At one point, the hotel industry was really focused on selling out all your rooms. You need to have a high occupancy. And then the industry shifted and said, well, what about your average daily rate? What if you sold all your rooms, but you sold them for $1? We really need to drive a high average rate. And then the industry got smart and said, wait a minute, there's something called RevPAR, and that is really more what's important than occupancy and ADR. So RevPAR stands for revenue per available room. PAR is per available room. And the calculation there, hopefully you're getting this, is your room revenue divided by your available rooms. Okay. So let's say that you had that same 100-room hotel and you have that same $1,000 revenue for the day. What's your rev par? Somebody tell me rev par. You had $1,000 revenue in a 100-room hotel. What's rev par for that day? There we go, Gina. Boom, 10. So you had a $10 RevPAR. And the reason that's important is hotel rooms are perishable. Okay. They're not like a banana. We're not going to throw them away. They don't perish like that. But if I have 100 rooms in my hotel, I can sell 100 rooms today. I can sell 100 rooms tomorrow and 100 and 100 for the most part. You can sell rooms twice, but for the most part, let's say you have 100, 100, 100, right? But if I don't sell all 100 today, I can't sell those tomorrow. And RevPAR is important because it factors in all those zeros. So if you didn't sell 90 rooms, those are all factored in as zero. That's why your RevPAR went down to 10, but your ADR was still 100. So who cares about $100 ADR if your RevPAR is 10, right? Conversely, let's say I sold one room to Hardeep for $1,000, and Hardeep wanted to pay $1,000. Great. My ADR was $1,000, but my RevPAR was still $10. It didn't matter. I still made $1,000, right? So here now we have our RevPAR, and then you have your room revenue. Okay. We have food and beverage if you have that. Then we have miscellaneous revenue. We're just kind of plugging these numbers in here, food and beverage or miscellaneous. So we get to our total revenue, and you'll see it's also calculating the percentage of revenue. And then the only other numbers you need to plug in are your GOP and NOI. We already talked about NOI. GOP is your gross operating profit. Real quick, that is your total revenue minus your operating expenses. That's how you get to gross operating profit. It's not net profit, it's gross operating profit. Okay. And I didn't have that because I have bad financial data that they gave me, but I do have my net operating income. And you can see here, some of these years are pretty high, 496,000, 790,000, 648,000. Those are really high numbers for a hotel that they want to get 4 million for, or 3.2 or 3.5 million. So now we have our cap rate here. And cap rate stands for capitalization rate. And what that is you're just dividing your NOI by what your purchase or your total purchase price was, or total all-in price was. Okay. So you can see here, this is like a 14 cap, 22 cap, 18 cap. You'll hear people talk about it like that. You'll probably hear more numbers like 8 cap, 9 cap, 10 cap, something like that. And the reason capitalization rate is important is it tells you how fast you're going to profit, how fast the profits turn into paying the hotel back. So like in really easy math, let's say that my NOI was $1 million and I paid $10 million for the property. That would be a 10 cap or 10%, meaning in 10 years I generated enough NOI to pay back what I paid for the hotel. Okay. And so now Cynthia's asking some good questions here. The question is like, from a cap rate perspective, what's a good cap rate? That's going to vary pretty wildly, but I can tell you that in like an economy deal like this, you really want to be buying a hotel somewhere between an 11, maybe like an 11 or 12 cap. But if you're buying just like a normal standard, again, I'm going to pick on Hampton Inn or Holiday Inn Express in a top 25 market, you're probably going to be buying it at an 8 cap or something. Okay. And we can go down a bunch of rabbit holes on that, but I don't want to bore you guys too much. I'm going to move on from some of this. So the historical data we have is not great. It's not granular, it's not detailed, but this is what they gave us. But it does show some interesting things. It shows me that there could be some real opportunity here. It could also mean that the seller just is not keeping good records and you can't trust the numbers, right? So what I do is I go down and figure out, okay, I'm gonna go make my pro forma year one assumptions. And again, we're just plugging in the blue stuff, right? So the first thing I want to figure out is what's the annual inflation for this market, right? And some markets are going to be different. This market probably is not 3%, it's probably more like 2%, meaning you're not going to see a lot of economic growth here for the most part because we're in the middle of Wisconsin. We're not in, again, South Beach or wherever. We're not in downtown, Charlotte or Raleigh, whatever. We're not in the best market. We're not in Phoenix, right? Now we have to figure out what's the occupancy and what's the ADR that we think we're going to run. And you can get the star report. You should be able to get a star report from the broker, or maybe you can get CoStar information. And we won't get a ton into that tonight, but if you do get a star report, that's going to show you what the market occupancy is and what the market average rate is, and what this hotel, ideally, what the hotel you're trying to buy is running. And once you have that, you can figure out, okay, if I were to run this hotel, how much do I think how would I perform? And so you'll plug in those year one numbers. So in this case, we used 40% occupancy at $60 average rate. Okay. Again, RevPAR $24. So that puts us at 998,000. And if you'll recall, that offering memorandum said this hotel was doing 1.2 million in revenue. And you can see it, right? You can see it kind of back in here. That is true. But when I model, I try to be a little more conservative. And if you remember, they also said that they're getting this big contract from Del Monte Foods. I've never seen the contract, so I don't know how long it is. I don't know if they can get it again, if that contract's going away. I don't know any of those things, right? So you have to figure that out in your due diligence. But for the sake of the model, I just dropped it a little bit. Miscellaneous revenue, I've got 150,000 in there. It could be a combination of some of that lease income slash money that you're going to get off of the slot machines. From an accounting perspective, some of that should really be below the line, like rental income should be below your GOP line. It should be more included in your net operating income. But for the sake of this model, let's say we're at 1.1 million in total revenue year one. I plugged in my GOP percentage and my NOI percentage, and those are going to vary. They're going to vary by brand, by location, by type of hotel, right? So an extended stay hotel might have a higher GOP than a transient hotel. An extended stay economy hotel is probably going to have a higher GOP than just a normal extended stay hotel. The higher your RevPAR is, the higher your profit margin should be typically, right? Because you're getting more money per available room, right? So like in hotels, remember there's fixed and variable costs, right? So again, let's say an example of fixed cost is more of a general manager, right? So I have one general manager. It doesn't matter if my hotel is running 100% occupancy or if it's running 50% occupancy. I still have that general manager, right? Again, the higher that RevPAR or the higher the revenue, typically the higher your profit margins can be. But in these economy hotels, you have to be careful because sometimes what will happen is you might have the owner who's running it as a general manager, and he or she's not paying themselves a salary, and then their sister or brother or spouse or whatever is cleaning rooms, and they're not paying them a salary. So what you see these really high NOI margins, and you can kind of see it in their historical numbers here, right? It's really hard to run 64% NOI margin on a $23 RevPAR. Is it impossible? Pretty much. It's pretty much impossible, right? You just can't do it. So you'll see here I have like 40 and 32%. And you're asking where do I get these numbers? And there are reports that can kind of show you and benchmark, these hotels in certain areas and stuff, but that's not It's not usually what people do. Usually what people do is they'll look at the history of what the hotel's done, and then they'll analyze it and they'll plug in numbers that they believe that they can run. And they do that I'm doing it from my historical knowledge in the industry, which I know isn't super helpful for you guys because I've been in the industry for 20 something years. But you can look at other deals as an example. You can talk to brokers, you can talk to other owners, you can talk to me or Devon. We can give you an idea of a range of where something should land. Um, and the other thing that will be helpful for you is the more deals you do, just like anything, the more times you practice it, the easier it'll become. But if you just want to analyze one deal per month, you're never going to get it, right? You need to put time, energy, and effort into this, right? You want to churn through it, analyze a bunch of deals, do a bunch of proformas, ask questions, figure it out. You could try Chat GPT. I don't like AI that much, but maybe I'm a dinosaur. I don't know. But it can be helpful. They may give you a range. So let's talk through debt assumptions, right? So we're going to move on and we're plugging in just the blue stuff, interest rate, right? So again, where do we get these numbers? You can talk to the brokers, you can talk to a debt broker, you can talk to, again, me, Devon, whoever, we can help you out to understand where the interest rate might come in or where the loan to value or loan to cost would be. Then you plug in your amortization period. And then it comes up with your annual payment here. Okay, so in this case, it's saying you're gonna have to put in 872,000 in equity, which is 25% of the deal. The loan amount is 2.6 million, and your annual payment is 224,000. Okay, so that's your debt assumptions. Then we're moving on to our sale assumptions. So we're going to use a terminal cap rate here. That means terminal means when I sell it, what cap rate am I going to sell it at? So I'm going to take, in this case, we're holding it for 5 years. You can change that to whatever you want, up to 10. So in 5 years, I'm going to sell it at a 9.5 cap, right? Okay. And maybe that's fair, maybe that's not, right? Maybe it's a 10 cap you're going to sell it at. So if that's the case, I sell it at a 10 cap, that means my sale price is 3.9 million. I'm gonna have some selling expenses. I gotta pay a broker, I gotta pay lawyers, whatever. So my net sale price is 3.8 million. So I'm selling for 34 or 35,000 per key. I bought it for 300 or 3.4 million. So my IRR is a 27 and my equity multiple is a 2.74. So anybody like the deal, not like the deal, tell me. And I'll go back through the questions I didn't answer. I'll make sure to hit those too. So we like the deal, we don't like the deal. Are we going to do it or are we not doing it? And what you really want to use this for is you want to do the analyzer and it should tell you, okay, should I move on and do a full-blown pro forma now, right? Does it make sense? Should I move to that next level, right? That's what you're looking to find out off of this pro forma. It's a good gut check to say, is this a good enough return or not? I'll tell you that most people now are looking to do deals somewhere between an 18% IRR on the low side and 25% on the high side. It doesn't mean that if it's lower than 18, you won't do it, or if it's higher than 25, you don't do it, but 27 is pretty good. An equity multiple of 2.74 is good. Those are good numbers. And again, keep in mind, the historical NOI was as high as 790,000. I dropped it to 360. So I dropped it $400,000. So I think there was some conservative numbers in there. You can mess around and maybe the interest rate comes in higher. Maybe the LTV comes in lower, to Steve's point. Steve asked, do you normally see LTVs above 60 or 70%? So I'd say if you're going to use SBA financing, you can certainly get above 70%. I've seen people as high as 85%. Because SBA will bolt on to traditional financing, and that's how you're getting that. You're picking up that extra, 10, 15%. So that could be helpful for you. Yeah, so I get it. I'm not telling you guys you have to submit money right now. I'm just saying, like, in a hypothetical scenario, do we like the deal or do we not like the deal? But again, as you're kind of messing around with things, maybe you can run better than 32% NOI. Maybe it can be a 35%. And look at that change from 32 to 35. It took it from a 27 to a 34, right? And keep in mind, we're talking about selling it. In this case, let's go back to 32. We're talking about selling it for 3.9 million. That's still 34,000. That's still underneath what they're asking for right now, right? So, I think it's an interesting deal. But again, we already talked about the negatives. It's in Wisconsin. Maybe that's a positive for you. Maybe it's negative. I don't know. But they get a lot of snow. It's built in 1984. You got a PIP you got to finish. You got this contract you don't know about. Maybe you can make 200,000 with the gaming. Maybe you put slot machines everywhere. But maybe the gaming laws change next year, and you can't make any money off of that, right? This is part of the risk of doing, commercial real estate deals, because you're just not sure. So I'm gonna go answer some more questions that came up, and feel free to continue to ask some for me. In the interim, I'm also gonna put in my information in here, so my email here for everybody. And website. So feel free to connect with me there. I'm also on LinkedIn too, as well. There was Cynthia had said, I'd evaluate the general contractor and trades labor shortage in the area that may impact renovation timeline and cost, right? Sure, that's true. One thing that could be helpful is if you have a PIP in hand, you can go to companies that will complete those renovations for you, and oftentimes they'll quote you the cost to do the PIP. And those companies also work with a lot of different general contractors, right? So that could be helpful. They'll do that for free oftentimes because they're trying to get business. Cynthia asked, will the bank finance acquisition and PIP and working capital, or do you ask investors to fund a portion or all? Yeah, so you know people don't love these answers, but it's true. The truth is every lender is different, every deal is different. But to give you more specifics, I have seen banks finance, yeah, they'll finance PIP acquisition and working capital, but you have to remember you're still going to put equity in the deal, right? So there's still some portion of all that you're paying for anyways, or that you're raising money for, right? But usually the working capital, is probably going to come out of equity, but some of it could come out of loan proceeds too, right? So, the bank's going to give you the money. It depends on how the bank does it. Sometimes the bank will put you on like a CapEx draw request. So in other words, you have to finish some of the capital work, and then you have to submit it to them, and they'll reimburse you, right? Or you submit it to them and they pay the vendor directly. Every loan is a little bit different. So some people are saying, like, if you had more information about the market, maybe you can make a more informed decision. I think that's true, sure. But on the surface, it felt like an interesting enough deal to show you guys, because there's a lot of different moving pieces to it. It wasn't just kind of a normal cookie cutter deal. And to be honest, this is what I look for. I look for deals that they need to have some kind of angle. And especially if you're going out raising money, you want to have a story for somebody. You want to have a story to the investor. It says, why should I give you money for this deal instead of somebody else for their deal, right? And there's different investors who like different types of deals. Some investors like the idea that there's a value add component, or some investors don't like that. They just want a deal that had strong, predictable cash flows, and they understand it, right? So if you put yourself in the mind of a general partner who's going out and trying to raise capital for this deal, you're going to have to run through. This is a potential landmine that you're facing right here. Meaning, they're going to say, well, okay, well, show me how the hotel did in the past. And you're going to have to say, well, I don't really know what the occupancy was over in these last 3 years. And they're going to say, well, how do you know you're going to be able to run 40%, right? So you want to kind of anticipate some of this stuff as well. But again, my point is once it passes the smell test or gut check or whatever you want to call it, you might move on to a more detailed pro forma, which we don't have time to get into tonight. But you would do your more detailed pro forma, at which point you'd say, what's my payroll going to be? What's my franchise cost going to be? How much you're going to spend on variable room labor, or all these different things, right? You put all that into your pro forma, and then you have a real good understanding of how well do I think this, will the deal perform. I can tell you most of the time when I do my analyzers, I'm off about 200 basis points, meaning maybe if I do my pro forma, my IRR comes out to a 25 or something like that. Sometimes I'm closer, sometimes it's 100 basis points, sometimes it's 50 basis points. Depends on the deal. So Steve said, I thought an owner's absentee and running two hotels with a skeleton crew, numbers may be off. Yeah, that's fair. I don't think you're wrong about that. You can also, when you go back into Google and when you're looking at these hotels, take a real hard look at their reviews, and that'll tell you a little bit of what you want to know too, or you can go out and stay at the hotel. That'll tell you what you like, some things about it as well. They could say, you know, pictures can be very different than what you see in person too, right? So keep that in mind. Yeah, and I think that's right. Carter said concerned about the total dependency on this particular one source. I think it's really important. I can tell you that I've been a part of deals or seen deals where the hotel picked up a really big piece of contract business. And maybe that contract business was or was not going to repeat. Even as the owner, you don't have a good grasp on that. And if somebody's coming in to buy that, they're either betting that that's going to continue, or they haven't done their due diligence to know if that piece of business is going to return in the future or not, right? So you have to be careful of what's called project business, right? So that's why you want to make sure there's other demand generators around that can support the hotel. Yeah, so all good points. What else you guys have for me? Anything else I can help you with tonight? Any other questions, thoughts, concerns? This is good stuff. Hopefully this was helpful for you. Hopefully I didn't put you to sleep. My wife says I put everybody to sleep on these calls, but it's not the most riveting information, but it can be interesting. It's a great industry. I love it. Right? If you do it right, you can make a lot of money. But if you do it wrong, you can lose a lot of money. So yeah, Sandy. Okay, got it. Good question. So elaborate on demand generators. So thinking about demand generators, that would be where the business is coming from, right? So examples of a demand generator could be an Air Force base, Army base, any type of military base. Airport could be a demand generator. Big industrial complex could be. Maybe I've got a hotel that's pretty close to an $11 billion liquid natural gas plant that they're continuing to expand upon. That's a demand generator, right? Yeah, stadium, university, those are demand generators. A big busy interstate is a demand generator, right? And typically you want to go into markets that have multiple ones that aren't just kind of anchored on one. And I don't think this one is, but they are getting a lot of their business from that big contract. The other thing I think is that I don't think the people that are running it are very sophisticated. I don't know anything about them, but everything I'm seeing tells me that, right? So that means there could be opportunities for a professional to come in and help you, improve operations. But what you don't want to do is you don't want to just take whatever the hotel was doing historically, like just take those NOI margins and then plug that into your model and say, oh, I can run 60% NOI. Well, okay, maybe you can, but that was probably going to mean that you and your husband, wife, kids, if you have any of these things, friends, family, are all moving there and you're all rolling up your sleeves and you're all going to do the work. Anybody ever seen the show called Schitt's Creek? My wife and I were just talking about it today. I love this show. I think it's hilarious, but they're rolling up their sleeves, working on the place, right? So that means your salary is paid for by the hotel, right? And but that's and a lot of people do that, right? And that's okay. But if you don't intend on doing that, you're probably not going to run really high profit margins. What's going on, Jameer? Hope you had some Chick-fil-A ice cream today, buddy. All right, I think that's all I have for you guys. Feel free to email me, go to my website, and connect with me on LinkedIn. Love to chat with you. If I can help you, I'd love to. But I appreciate your time this evening, and anything you need from me, you know where to find me. So, anything
All
else,
right.
Davon?
All right. Thank you all so much. Thank you, Tommy. Y'all show Tommy some love. This is great. And so this will be what the replay will be available within 24 hours. So we appreciate you all. Thank you all so much for tuning in. I know that you all learned something. Because every time Tommy speaks, we always learn something. So thank you, Tommy. And we appreciate you all. You all have a great week.
Take care. Have a good night.
Thank you. Happy.